Well, we are talking to an expert in old people because he is one. Gene Pastula, certified financial planner. Of course, I can't talk, well, you're a tiny bit older than me. I think both of us have a great expertise in what older people need from a financial planning perspective, because between us, we probably have 80 years plus.
You know, that's one of the things that I mention to people a lot when I'm in an advisory capacity is, a lot of the financial planners that are there, that are, really doing well and all the rest of the stuff, they're in their maybe middle 40s to middle 50s if they're really at the point where they're doing well, etc. That's too young to truly understand at the gut level what a person who's in their 70s and 80s, how they feel about things and how they deal and process things and stuff like that. To them, the idea of, hey, I know the market just tanked 40%, but you got to, now's the time it's going to go back up. You can't get out now. In fact, let's move some more money in here and we'll do it. And he or she is probably right.
Yeah, at 45 years old, you can get away with that.
Well,
but at 75 years old, you really can't.
You can, but the stress level and the uncertainty and all the rest of the stuff isn't worth it.
Now, for all of the 45 and 50-year-old and 25 and 35-year-old financial advisors that tune into this show every day, that was not a rub on all of y'all. Was it? Or was it?
Yeah, it was.
Of course it was.
No, it wasn't. Well, the point is that, it's not them trying to, to mess with you or, take advantage or anything else. It's just that they have not experienced what, in their gut, what people do. My favorite line of a client who was in his 70s when I was in my late 40s or early 50s, somewhere around there, he said to me, son, I don't even eat green bananas, green bananas, So, it's a different perspective, and it's an important one because there is no point in having money and also having the stress and concern about losing it. So if you set up something, and life insurance is a classic example of a vehicle that older people should seriously consider. It's different when you're 35 or 40 and raising a family. Life insurance is a what-if product. When you're 70 years old or older, it's a when product, okay? That turns it from insurance for a potential serious financial issue to a investment.
A guaranteed rate of return.
Exactly, and you're going to put money into that, and it's going to yield a result somewhere out in the hinterlands. And the cash value that you put into, the money you put into the cash value of a life insurance policy is every bit as worthy as a savings account, if you will, to a cash value or of a CD or a bank account or a money market account.
That's true. It's so true, especially in this low interest rate environment. Back when you could get 6, 7, 8% in CDs, maybe one could have made the argument that the life insurance policy was not as competitive, although
they were making 8, 9%.
They were doing the same thing.
No, cash values of insurance policies, in my experience, which goes back the last 40 some odd years, has always had a crediting rate that is higher than the CD rate. And now there's a hit against it for the cost of the insurance that's incorporated in it, but even when you bring that down, and so you bring the net down, it still is every bit as competitive as a bank account. Plus, it's not taxed until you take out the gain, and it's not taxed when it all distributes to your heirs with an additional lump sum of pure life insurance. So, from an investment point of view, I did a case a couple of years ago, which I use as an example all the time, of an individual who was 72 years old at the time, and he had contacted me because his daughter was on his case about getting long-term care insurance, and he didn't want to. He was a widower, and but he heard me on your show, as a matter of fact, and wanted to look into this. And so we ended up. He had a small, actually, as a modest-sized IRA that he didn't need for income, but he had to take like $1,500 a year out of it, required minimum distribution, right, and pay the taxes, etc. So we ended up putting $12,000 and change, the after-tax value we calculated, into a life insurance policy that was for $235,000. That would pay for long-term care. I mean, he could tap the $235,000 for long-term care, and if he didn't use it, which he said, "I'll never use it." I mean, he personally convinced. He just wanted to get his daughter off his back.
Right.
But when we looked into it, and I showed him the rate of return on turning $12,300 a year into 190 or 290, whatever it was, that $290,000. The rate of return was, by the time, if he lived to 94, the rate of return was something like 5.5% or 6%.
Tax-free.
Yeah, tax-free. Now, it's not quite that good today because interest rates have been so low and everything else, but it's still highly respectable, and certainly better than any other safe, guaranteed, predictable result. I told him if he wanted to get a higher rate of return, maybe he should die at 85. Which would be his life expectancy anyway. So he, fulfilled his obligation to live.
Yeah, I've looked at those, and in fact, it wasn't that long ago. Was it you or Tim or one of the people at your office ran an illustration for me personally and Jeannie on a second to die insurance policy? Because here's what I figured out. Because I was one that, I bought a lot of life insurance when my kids were growing up, and now that they're all grown and hopefully doing well, you say, well, I don't think I need life insurance anymore. But when Jeannie and I talk about our financial goals, high on the list is our grandkids. And we're thinking about, we live in California. Well, how's a grandkid going to afford a down payment of $100,000 or $200,000? Because you can't buy a house in our neighborhood for less than $800,000 if you want to stay close to the rest of the family. It's just impossible. Unless you want to live in a small apartment or something.
There's a trailer out in the boondocks that I pass.
That's where I'm living right now. You didn't know that.
It has a for sale sign on it. I haven't checked it out.
But you know what I'm saying.
Sure,
you want to help your grandkids out, and you say, well, when I croak, I want to be able to spend all of the money that we've amassed. I don't want to have to, worry about us
how much you're
living. I want to have a legacy that I don't think about.
Yeah.
So how can you help me do that?
Yeah, well, and so an insurance contract obviously can do that because you can identify the exact amount of the legacy, unless you have to spend it yourself, typically because you need care. And some people will be in a situation where they need to have somebody take care of them for 2 or 3 years, or even longer. So when you set up these insurance contracts, and then you you use the kind that says, if long-term care, which is the number one biggest expense that 99% of all Americans face in retirement.
Yep.
There's estate transfer costs, the taxes and estate taxes and the like on some people, but most of us, half of us will spend a ton of money on long-term care, and some of that half will spend a big bunch on long-term care because we'll use it for a much longer time than just a few months or a year. So now you set up an insurance contract that will pay off, and then know that it could pay you if you need it. So you're going to give them a phone number, aren't you?
Yeah, I am.
Yeah,
because you don't know your own phone number. If you want to contact Mr. Gene Pastula, and I think you should, 800-809-6783. 800-809-6783, or go to safemoneymonitor.com. He's a CFP, and he's the guy that's been on this program for years and years and years.